Hi everyone, this is Joe Gentili from Sarraf Gentile LLP. Today I want to describe a common pitfall that exists with index universal life insurance policies to be mindful of if you're looking to purchase one or you already have. So the pitfall has to do with the index options that are provided. In recent years, a lot of these IUL policies have been sold basically touting these what we call synthetic or engineered index options. So not the S&P 500, but it'll be some brand name financial institution, so and so low volatility ER index or excess return index or some version of that. And a lot of times to incentivize people to put money in these indexes, there'll be these bonuses that are given or really high participation rates. So they look fantastic. And a lot of times the backcasted or backtested results, by the way, it's not always clearly disclosed, but those results a lot of times are not historical. They're showing you hypothetical results. If this index existed for the last 20 years, how well it would have done. And the numbers on some of these are amazing. They're showing, 20% annual returns in some cases, just really fantastic numbers. So they paint this really great picture. They show that you have this potential, you invest in this index, 20% returns, 15% returns, and then they'll illustrate what your policy looks like at a much more conservative return, and the policy looks great over time. But even that conservative number is a reach. In most cases, that's not disclosed to people, but that's the case. But anyway, the a lot of these indexes are what's known as excess return indexes. And those excess return indexes can look phenomenal when you have low interest rates. So if these policies or these indexes, there's a back results and it's stretching out over this long period of time with really low interest rates, the policies can, or the returns on these indexes can look fantastic. But now we don't have low interest rates. Now, recently interest rates were over 5%. Now they're just under 5%, but they're still relatively high. The reason why that matters and what's not typically disclosed to people is that the way an excess return index works is that current interest rates operate like a hurdle that you have to jump over to get a positive return. So just to keep it simple, if current interest rates are 5%, you have to get in the index has to get over 5% return before you get any positive return. So the interest rate is deducted from the return. The return is net of the interest rate. You're getting what's in excess of the interest rate. So that interest rate operates like a backdoor fee or a backdoor expense. So a lot of people are getting really underwhelming returns with excess return funds now because when they're shown on their illustration, how this excess return index performed over time, it looks great because they're showing them a period of time when interest rates are like 1%, right? But now that they're around 5%, you're taking a relatively small hurdle that these indexes have to jump over to look good to a really big one now. So they're a bit misleading. So I think that if you're looking at buying one of these IUL funds and you're getting sold on one of these brand name indexes that's being pushed, take some time to figure out whether it's an excess return fund and how exactly that works. Because chances are it's either gonna be explained in the fine print or that fine print's not going to be there at all. Ask the agent. Have the agent provide you with fact sheets or things like that to try to understand what it is that you're putting your money into. If you've already put money into one of these and you're getting lackluster results for it, you could have grounds for filing a lawsuit against the carrier. If the carrier didn't disclose or didn't adequately disclose what it is that you're being steered to put your money into, then you could have a claim. So if you have any questions, feel free to reach out to me. I'm happy to discuss this further. Otherwise, thanks for watching, and I hope you have a great day. Bye.